Welcome into the Ether, a podcast brought to you by ETHUB, the essential source for Ethereum information. Don't let high gas costs keep you out of Ethereum. On Balancer, you can trade all you want and receive gas costs back in your wallet. With their new BAL for Gas campaign, traders are receiving 6 figures worth of BAL tokens every week. With deep liquidity and great prices on trades, this is a no-brainer in my opinion to check out. Balancer V2 is also just around the corner with some exciting new features. These include bringing stable and weighted pools under a single protocol, along with flash loans, lending via asset managers, and much more. It really is becoming the one-stop shop for DeFi liquidity. Head over to balancer.finance to check it out. Hello everyone, and welcome to the ETHUB Weekly Recap. In these episodes, we discuss the latest news from the Ethereum ecosystem and crypto space as a whole. This week, we are covering the news from June 14th to June 20th, 2021. Hey Anthony, want to walk us through the news?
Hey Eric, well, what a volatile week in the markets. Hey, ETH is not looking too hot right now. Crypto markets in general not really looking too hot right now, but that's okay. We're still long-term investors, right? Anyway, I think other than the price kind of like action of the week, a lot happened. And one thing that I wanted to talk about before we jumped into all the news was the fact that Gitcoin Grants round 10 is now live. So we've spoken about Gitcoin Grants a lot on the podcast before, and how you can donate to all of your favorite projects on there, and that can be quadratically matched. So yeah, I wanted to extend a big thank you to everyone who's donated to ETHUB's Gitcoin Grants so far. We obviously really appreciate it. And if you haven't done so, and you wanted to, you can just find the link to that in the newsletter. But I think, don't just donate to ETHUB, of course. Donate to all the projects, I think, that you regularly use or want to support on Gitcoin. And one thing that I think people should be doing is kind of scrolling through and looking for underrated projects or projects that aren't getting that much attention, because I think I've long held the belief that Gitcoin Grants is amazing, but it's also a popularity contest where the most well-known projects are going to get the most donations, right? And then subsequently the most matching and the most kind of funds allocated to them. Now, popularity of a project is obviously going to correlate to how many people are using it, and there's different Sybil-resistant mechanisms in place to kind of like prevent people from gaming the system as well, which is pretty cool. But generally, I think that there are a lot of projects out there that are doing a lot of good work, and they're just behind the scenes. So people may be using them, but not actually know that they're using them. So there's a few like developer libraries on there that people, that developers obviously use, and people are getting a lot of use out of that because they're using the smart contracts that were built using those tools, but they just don't know about them because of the fact that it's in the background. So yeah, I encourage people to go have a look at that, and go see newer projects and projects they may not have thought of donating to before, and see what you can find there. There's a bunch of collections on there now on Gitcoin that you can check out too. So yeah, highly recommend going and doing that. And yeah, just donating what you can to whatever projects that you kind of come across there.
Yeah, no, for sure. And we've talked about this a lot in the past with Gitcoin Grants. It's definitely one of the bigger problems. I guess now maybe like the token holders can help figure this out or something. Now that they have a token, I don't know how that's going to work. But curation of the grants from the side of, making sure you're displaying grants that aren't like a scam or whatever, or worthless projects that are like fake, that's one issue. And then displaying them has always been a huge challenge, because Gitcoin Grants like 1, 2, 3 rounds, there weren't that many projects, right? Like I don't even know if there were like 100 in the early rounds, and now there's hundreds, maybe thousands. I haven't really checked lately, but it's hard to like sort through and like know where to go, right? And that like the checkout process has gotten better over time, which helps. But I think that I've said this a few times. I something's going to have to happen with these grants where it's more like fewer teams get more money. So I'm not convinced that 1,000 teams getting $200 is better than 200 teams getting $1,000, right? There's a point where it's kind of like, okay, that was nice, we got this money, but is it really helpful? You know what I mean? So it'll be interesting to see if that's like maybe an approach in the future that Gitcoin tries to take. And maybe it's like every other round, somehow there's like voting done, or like the 10 or 20 projects that should get all the money, and then the round it's smaller. But then it becomes a popularity contest. It's a tough problem, right? But there is a point where it's like, okay, we got a $220 or something. It's nice, but like that's not going to help us pay for an engineer on our team or like even server for like a month, right? So a lot of interesting challenges for Gitcoin going ahead. But I mean, it's funny that grants has become such a staple in the Ethereum ecosystem.
Yeah. I mean, I totally agree there. I think the original kind of point, I guess, of Gitcoin grants and kind of persists to this day is that it should be a way for like open source developers or open source like anything to get funding. And yeah, of course, if the funds are too spread out, then no one kind of I guess no handful of projects will get the right funding and things like that. But yeah, I mean, it's definitely not the perfect system yet, and it's been iterated on each round, and I think it's getting better as time goes on. And it's funny because like in some of the rounds, it was sorted, like the grants were sorted a certain way, and then when you change the sorting, it would actually change like the outcome, and you know, and like who people donated to. And this is funny because this happens a lot in the Web 2 world, where social media apps will basically, you know, or just websites in general, like you know, depending on where you place things, will people will kind of like be more likely to click it. So that's why a lot of the, you know, the things that you want people to pay attention to on a website, you place on like the very first page, and you place it what's called above the fold. So you place it on like the top of the page where people first see it, and that's like just a really easy way to get people to look at it. But if you were to change that, right, and say you place like the button, like the call to action button of your website just below the fold, you would actually see like a material drop off in the amount of people that clicked on that. So same thing with Gitcoin grants, like depending on how you default order the grants list will kind of like dictate, you know, which projects get what amount of funding and things like that. So yeah, going to be an interesting thing to work through there and see how the Web 2 and Web 3 worlds kind of collide there. All right, on to the news from the week. So I guess this is a bunch of news that came out, I guess last week and the week before, around China and China's like massive crackdown on crypto. Now, you know, you might be thinking, oh wow, that sounds familiar. Like we've had this before. You know, it's always been FUD. Unfortunately, this time it has not been FUD. It is very, very real. So the China crypto crackdown isn't just for Bitcoin mining. They've also cracked down on exchanges, especially leverage trading on exchanges, which I think we've mentioned before, where we said that we don't imagine like, you know, every government in the world keeping leverage trading going, especially because you know, at least for retail investors, because it just leads to so much wreckage at the end of the day. But yeah, the mining ban's a pretty big deal because a lot of the miners are moving overseas now. A lot of them are shutting down. You know, a lot of them have to get out of China, and by kind of like cutting off those fiat on ramps as well, they're cutting off a lot of the potential money supply. So I think what we're seeing or at least fresh money coming into crypto. So I think what we're seeing in the markets right now is we're seeing like a bull and bear battle that maybe is not like, maybe generally people aren't bearish, but they're forced to sell. Like in China, I think a lot of miners have been forced to sell. A lot of people generally have been, you know, because they've cut off the new money flow. It's very hard for things to go up. But then you have the West, which like, you know, the US, Europe, all that, which is still seems to be bullish. Like, I mean, obviously my Twitter feed is very curated towards the West. I don't really have like that much of a view into China, but like everyone that I kind of like can see, or at least most people, are still pretty bullish on things. So I think maybe what we're seeing is that an east sell-off and a west buy-up. But, you know, the sell-off is pretty extreme because of the fact that it's such a huge crackdown on such a huge population. I mean, China is not a small kind of country. There's 1.5 billion kind of like people there last time I checked, or something like that. So, you know, by cutting off that, you cut off like a massive kind of like tap for the crypto markets. But yeah, I mean, I think just short-term to medium-term, it's going to be bearish because of that. But long-term, I think is fine. I mean, unless you start seeing more and more governments around the world do this kind of major crackdown. I don't see this happening in the West. Like I couldn't see like any the US doing this, like clamping down like this and banning kind of like mining and just outright doing all this kind of stuff that China's doing. And, you know, Europe, I mean, maybe some countries in Europe do it. Europe's a big kind of like place, but generally, I just don't see this happening there. But still, I mean, I think I mentioned a couple of weeks ago or something that we've entered the geopolitical era of crypto now, because we saw the El Salvador stuff come along, and now we have China cracking down. You know, just because we're entering the geopolitical arena doesn't mean it's all going to be positive. There's probably going to be more negatives than positives, because at the end of the day, crypto was created to take on governments and nation states and their ability to print money. They're not just going to sit idly by and just let that happen. Like, that's just not happening. And I always thought that was a bit of a delusion from Bitcoin maximalists who said, oh, China can't ban this because if they do, they'll cede power to the US. It's like, guys, like, China don't give a shit. Like they're gonna do what they're gonna do, and maybe you're right. Maybe they are right, and eventually, they lose out because they kind of like I guess banned crypto or whatever. But I don't know. I think the jury's still out on that. But yeah, Eric, I'm curious to get your side here.
Yeah, I mean, USD is still king, right? And I think will be for a long time to go. I don't really see Bitcoin taking that spot. Maybe something like ETH, but then even then, we like USD stable coins are dominant on Ethereum as well. So that's an interesting, long term discussion there. But yeah, the China thing's funny, right? Like this goes back to, I mean, when I first got into crypto, I mean, people were talking about China bans and like exchanges going offline and stuff like that. So this has been going for many years. But it's really, this does feel like the Band-Aid pull off, right? Like there's videos of, miners having to shut their rigs down and like rigs being sold really cheap versus what they would have normally gone for and being shipped out, mining rigs that is, and definitely crackdowns on exchanges. This seems like the real one, right? So, what does this mean? I mean, it's important, right? I don't think it could definitely agree it's important and can't just be shrugged off. I mean, like you said, China's a huge country. I mean, it's probably like a fourth of all the bid probably in Bitcoin and the crypto space as far as on exchanges and people buying and selling. So it's big. Like it's going to be interesting to see. Yeah, maybe that's creating a lot of sell pressure right now, but what does the buy pressure, how does that hurt from, China being basically taken offline, not from just mining and using Bitcoin and crypto, but from buying and selling it as well. So yeah, the geopolitical thing is going to be rocky, right? I mean, we're definitely going to enter the stage of that and regulations inside the US too, right? Like governments are slow to react and they're not going to let this stuff just go unregulated, right? So it might take years just because politicians are generally older and behind the times and don't know how to react to this stuff. Unfortunately, that means they'll probably try to put down smothering regulation at first just because they don't fully understand it. Maybe we see that on stable coins eventually in the US. I've seen some buzzing about that for, God, what seems 2 years now or something. But that's not all bad, right? Like there is, I mean, you and I aren't fans of regulation, but there are some small benefits. It gives it legitimacy, right? So as long as countries like the US and Australia and, and the EU and stuff like that, as long as those areas are friendly to it and not just outright banning it like China did, which I really doubt they would, right? There's very different political ideologies between the Chinese government and, say, the United States government when it comes to this kind of stuff, currencies and financial freedoms and whatnot. But there will be a day where this feels threatening to governments, right? Especially as things like DeFi build out. Like I was never a believer that Bitcoin was going to be a challenge for governments because, yeah, I mean, it's a store of value gold meme, right? That can be kind of shut down super easy because everything's done through fiat on and off ramps. And not to say that doesn't happen for Ethereum as well, but there is an element to Ethereum where you could on ramp and theoretically pretty much just stay exclusively on DeFi and even use mixers and all of that stuff, and kind of just live your life in DeFi. Now, of course, you still have to like eventually kind of cash out stuff, but there are ways, and especially as privacy solutions come online, that you could get away with this pretty untraced. So regulation, geopolitical environment is definitely a big narrative over the coming 5 or 10 years because we're in the mainstream route now. I don't think there's any denying that. And now governments will pretty much be forced to have to react to that.
Yeah, I mean, and you mentioned like regulations. I think generally we're not fans of it. I think maybe the better way to put it is that we're not fans of like overregulation because unfortunately, as much as I would love to believe that the free market solves all the problems, I don't believe it does. I think that there are problems out there that humans just can't control themselves over. Like people speculating with leverage on these just absolute shit scams and falling into traps. Like this is why financial regulations exist in the traditional finance, or a lot of them at least, is because people just can't control themselves. And I'm not going to say that I can control myself and that, I mean, but either of us, like, we've made mistakes in the past and sure, we fall into traps sometimes too. But I think just generally when you give like retail traders like new to this ecosystem 100 times leverage on just like complete, shit coins for lack of a better term, it just, that's the kind of stuff that invites the regulation to start, right? Because retail's always going to go crying to daddy government when they lose money. They're going to go crying to someone. They want someone to make them whole, whether that be through some kind of regulation or whether that be in some other way. So from kind of like that perspective, I mean, I can see it, and it does work. Like, I mean, it does stifle the people who want to do this, but if the people who want to do it are like a minority, then for the majority, it does work by kind of like locking them out here. But again, I'm not really a big fan of it because I just hate like, you know, government being in my life too much. Like generally, I would like less government in my life, especially when it comes to, you know, regulating what I can and can't do, and especially when it comes to financial markets, because I believe that having an open financial system generally is a much bigger net positive than kind of like the negatives, because you give everyone kind of like this level playing field, and you don't just I guess like make one group you know, the priority over another. We saw that obviously with you know, I guess like traditional finance over the past, whatever it is, like you can say 100 years, especially in the US, where there's definitely, you know, groups that have been favored by these regulations, and some of them even write these regulations. So that's why I think that I kind of push back against it. But I can't blame governments for shutting down like this leverage trading that's been going on, because it's just absolutely insane for uneducated retail investors to just be throwing money like this away. But at the same time, you know, how about you regulate gambling the same way, governments?
Right. Yeah, exactly. Yeah, it's funny how that doesn't occur, right? But I mean, fully agree with you. It's like when the one bad kid in class would ruin it for everyone else, or like on the team, and then you had to run laps because of the one kid that
Yeah.
screwed up or did something bad, right? Like we all pay for people, you know, who bought in Dogecoin version 30 whatever fork, and you know, lost their mortgage or whatever, and all of a sudden things get regulated. Unfortunately, that's just how things work.
Yep, exactly. Unfortunately. But anyway, we'll move on to the project updates from the week now. So, some exciting updates for London, the hard fork or the network upgrade that's going to be including EIP 1559. The test nets have been detailed. So, they'll be going live, I believe, on the 24th of June onto Ropsten, I think the 31st, or like a week later onto Gurley, and then a week later onto, I think, Kovan, or another testnet that I'm forgetting the name of right now, but a Rinkeby on July 7th. So, and then a mainnet date has not been set yet. So this is obviously the final stage before we can get it onto mainnet. If the testnets go fine, I'm expecting a late July, early August deployment to mainnet here. Unfortunately, you know, we didn't get the July 14th date that was originally kind of like, I guess, slotted, but that wasn't ever a date that was given as like a set date. It was a tentative like target date, and you know, if we missed it, it wasn't a big deal. And I still don't think it's a big deal. I mean, as we've said, like, what's another 2-3 weeks to wait for 1559 after waiting so long? Especially during this market. I don't think that 1559 going live is going to do anything for the price of ETH in the short to medium term, especially given like the current sentiment out there and the current kind of like market we're in. But the thing is that Ethereum always optimizes for the long term, right? Because when we do upgrades, we don't think, oh, okay, we got to get this upgrade in because it's a bull market and it needs to happen so that we capture all the value here. No, when Ethereum kind of like does upgrades, it doesn't kind of tune them based on the market. It will just do it as safely and securely as possible. And I'm very glad that that's being stuck to. I don't want to see a world where the Ethereum protocol rushes things through just to kind of like meet markets and meet market demand or whatever. Because I guess like how some people would say, well, you know, Ethereum is like a public company, and the Ethereum network should serve ETH the asset as like and should serve ETH holders. It's like, okay, well, it does, but over the longer term, it's not gonna basically try to time markets or whatever. That's just not the game that we're in here. So yeah, I'm glad to see that you know, these dates haven't been kind of like, you know, never like kind of, I guess, like prioritized to be faster just for the market action. But yeah, generally another thing on 1559 is people saying, oh, well, gas fees are cheap, you know, we're not going to burn much ETH anyway. It's like, guys, like, it's cheap now. It's not going to be cheap forever because the market is not going to be quiet forever. And even when the funny thing is, even when market volatility just picks up by a little bit, the gas prices spike back up like instantly. I mean, it was 10 Gwei a couple of days ago, and then we had this volatility in the market, and gas prices are now at like 60 or something for rapid transactions, or even 80, I'm just seeing here. So, yeah, I just think it's a bit like, a bit silly to think that gas prices are going to stay low forever. And I mean, the only way that would stay low forever and keep trending down is if Ethereum actually kind of like died, which obviously we don't think is going to happen. So, Yeah, but anyway, Eric, yeah, your thoughts here, I guess, like on the dates and the meaning of 1559.
Yeah, well, I've put my Twitter on ice until this launches. I thought, honestly, I just wanted a little bit of break with things opening up in the US and having a new baby and wanting to enjoy summer a little bit. But so I figured it'd be a good thing, maybe to come back for, right? There's been, at least I've put a lot of work into this. You've put a lot of work into helping push 1559 through with educating about it and just, us getting the word out there. It seems a fitting thing for me to pop back on Twitter eventually with. So I guess these dates are fairly important for me when it comes to that, although I'm not really minding the break right now. Hopefully this doesn't get like a weird 1 year delay or something and I turn into like you with when you couldn't tweet until I forget what the price was at this point.
The old all-time high. It was like 1400 or whatever.
Right. So funny, man. That feels like 5 years ago at this point. That's funny.
Yeah, it does.
But yeah, no, it's just good to see like ETH1 upgrades happening, right? Like the fact that there were even just having like minor little pushbacks to like July, early August instead of like, oh, we've been delayed 8 months or something like that, right? It's really good to see the ETH1 teams. I mean, they've been crushing it, pushing things along. And like we said, this is going to be one of the biggest moments in Ethereum's history. I agree with you. I think short term, it's not going to do much for price. I think that aspect is priced in, right? Like there's an aspect to, I see a lot of people say all the time, oh, you think price is going to go down even with X, Y, and Z happening. And a lot of that is priced in, right? It's hard to really know, but like people know 1559 is coming. Now, what we don't know is the real impact of the burnt ETH, right? So currently we all know we're oversupplying to miners. We're not burning any ETH for transaction fees. This is going to change now, and that dynamic's very hard to model, right? What kind of impact is this going to have? It's going to relieve a lot of sell pressure, and it's going to burn a lot of ETH forever, shrink the supply. How will that impact price? And I don't think we'll really know that for a good amount of time, maybe a year, 2 years, to be honest. And even then it's hard to like price, right? Because you're kind of coupling it with all this other stuff, right? Like the China ban, for instance, right now, and just the general bull and bear cycle of the market. So I don't really expect like the block to activate 1559 and we pump. I don't see that at all. But long term, I mean, this is probably the most, well, besides like supply reductions that we've done in the past, this has to be the most bullish thing that's actually like gone in the protocol itself, right?
Yeah, I think so. And this is the thing, right? We have 1559. We have the merge, happening too, which I think will be bigger than 1559, obviously. And then we have like all the other stuff still happening on Ethereum. I don't know, like it's just funny when I look at all the fundamental stuff and kind of like I can't be bearish. I mean, at the moment, I feel like we're kind of like back in maybe 2019 and we're talking on like the podcast and we're going on about how can you be bearish given like everything that's coming? Like short term is whatever, but long term is going to be fine. And I think, we were obviously right back then. And I think now's the same kind of thing. It's like short term, I mean, we've all been here. Like for long term listeners of ETH Hub, I know we have a lot of new listeners, but for the long term listeners, you've been here with us before. We how we kind of look at these things. There was a lot of things that actually, a lot of groundwork that got laid during the last bear market that definitely didn't kind of affect the price of ETH until later on, where people started kind of pointing to it and being like, oh, wow, DeFi is actually a huge thing now. It's like, well, okay, DeFi, the foundations were laid during the bear market, guys. Like, the only reason you can use these things is because of the building in the bear market. So, if we do go into another long drawn out one here, which the jury's still out on, I believe, but we'll see. I don't think that we're gonna kind of like have bearishness on the fundamental side. There's so many more teams now. Everyone's funded. I think it's going to be great going forward on that front as well.
Aave is my favorite way to lend and borrow crypto on Ethereum. A true cornerstone of DeFi, Aave allows for a non-custodial way to earn interest on your crypto or to borrow assets of your choice. Building on top of their extremely successful V1, the recent launch of V2 has brought powerful features such as collateral swaps, credit delegation, improvements to flash loans, and much more. There is no doubt in my mind that DeFi is the future of finance, and Aave is continuously a leader in making that a reality. Head over to aave.com to get started. That's AAVE.com. The Grid Plus lattice is changing the way users interact with Ethereum applications by revolutionizing the hardware wallet experience. The lattice is your single signing hub for all Ethereum accounts, allowing you to quickly switch between PIN-protected safeguard wallets. On top of that, it features a large touchscreen that gives you the ability to see exactly what you're signing before you submit a transaction. No more hitting send and hoping for the best. I've had the pleasure of using a lattice over the past few months, and it's become my favorite way to manage my accounts and interact with my favorite DeFi applications. It's clear to me that this is the future of interacting with Ethereum. Head over to gridplus.io to get started.
All right, on to the next update. So Maker has detailed a new feature that they're implementing called Flash Minting. So it's a Flash Mint module, they're calling it. What this allows Maker to do is basically issue Flash loans for up to 500 million in DAI. So the way this would work is that essentially the way people do Flash loans now is that they borrow DAI from like Aave or I think DYDX had this, and there's some other platforms that have this. But they're only able to borrow the amount that is available in the liquidity pool. Whereas because Maker is the one that actually issues this DAI, they're able to mint, and 500 million, I believe, is just like an initial limit they've put on. They could theoretically Flash mint any amount of DAI as long as it's paid back in the same block like a normal Flash loan here, because they are obviously the issuers of DAI here, and it would be treated as if it was real DAI by the market. So I think this is really, really cool because one, it brings another revenue source to Maker because I'm sure they're going to charge a fee for people to do this, and two, it fixes a lot of the issues around kind of like liquidity that people will face when they're doing Flash loans, because like, oh, I can only do a Flash loan of this size because the liquidity is only there for this size. And you know, what does this mean for the other Flash loan platforms? Like, I think it's going to be fine because they offer more than just DAI. Maker can only offer DAI Flash minting for now. I mean, maybe not even for now, for like the foreseeable future, because the only reason why they can do that is because that Maker is the issuer of DAI. They're not the issuer of any other asset. Whereas Aave and other Flash loan enabled platforms allow you to do this with, I think, any asset. So you can do it with like ETH or like other stable coins or other kind of like assets. So I think they're going to be fine. But in terms of like the DAI use case, it would probably be a no-brainer just to use Maker for your DAI needs, especially because I imagine they might undercut on the fees here to try and like get some kind of action there. And I think going forward, it's going to be cool to see how many people use Maker, Maker's DAI Flash minting instead of just using Flash loans through something like Aave or something like that. So yeah, really cool to see Maker getting into the Flash loan game here.
Yeah, for sure. Like if you're a protocol that has the potential to tap into deep liquidity, it seems like a no-brainer, right? And this is something that we've talked about recently, in competition breeding innovation and kind of pushing teams to, all of a sudden we have like competing DeFi protocols, right? And underneath there, in the long run, token holders are going to want a cut of some like SushiSwap, for example. Like Sushi holders get a cut of protocol fees. A lot of teams haven't quite implemented yet, or I guess token holders haven't quite implemented yet. Uniswap would be one example, but in the long run, we're going to have token holders wanting a cut of protocol fees, and that means that there's going to be a big push to, you know, implement new features, maybe something that's worked for another team that's bringing in profits, like you said, to take out a Flash loan. They're probably going to charge for this like Aave does, right? So eventually, though, what's good about that for the users too is there'll be a race to the bottom on fees. So say all of a sudden, I don't know what Aave charges for Flash loans, but let's just make it up and say they charge 5 basis points or whatever, which is 0.05%. Let's say now Maker comes in and does a little less. Aave might have to respond to that, right? So there might be this competition, and that's good for the users at the end of the day. And I think we're really going to see this on DEXs, which is actually, not to sidetrack here, what's really interesting is, I don't know if people have realized, but the ETH USD trading on Uniswap V3 has now been pushed to the 0.05% fee pool instead of the 0.3% pool. That's because of the capital efficiency of V3, and people will be able to set tighter ranges. They can make more in fees because of those tighter ranges, and Uniswap automatically routes to certain pools based on what the best trade is. So traders are getting a 15%. They're paying 15% of what they used to on ETHUSD trades on Uniswap, which is awesome. So a bit of a sidetrack there, but it kind of goes with my narrative of I think fees are going to get pushed low over time. Token holders aren't going to want to push them too low because that's going to be like the source of revenue for these holders. But it's cool just to see like DeFi teams still innovating, right? And like a lot of these teams are like flush with cash, right? And like I'm not totally sold on fully decentralized governance yet and token holders being able to push things like this through. So it's good to see that teams are still like working and implementing features, right? And it makes sense. Everyone kind of knows DeFi is the future, so you're going to want one of the staple protocols. But yeah, nice to see this and have different options. I'm not personally writing any flash loan things, but good for people that are.
Yeah, I'm not using any flash loans, that's for sure. I don't really have anything that I would use them for, but there are obviously a lot of people that do. They've been very popular in the past. I think that people maybe know flash loans because of a lot of the exploits that have happened where flash loans, I guess, make it easier to exploit things. And you know what? I actually think that's a positive because what it does is it just battle tests these systems much faster than we could have because, no one's really risking any capital here because, for those who don't know how flash loans work, it essentially allows you to borrow any amount of an asset as long as you pay it back within the same Ethereum block. So you can borrow $1 billion worth of DAI or whatever and go do something with it on chain. And then as long as you pay that back within the same Ethereum block, the transaction will execute. If you don't pay back that full amount, the entire transaction will fail. So anything you did with that 1 billion DAI will fail. So I actually think that this is really cool because it means that literally anyone out there can do an economic exploit on any protocol from anywhere in the world without having to have a capital requirement, for instance. And this means that, the top security researchers, or at least someone who's like found a bug can attempt to exploit it themselves if they want, or they can report it to kind of like the team if they the teams if they want, and the teams can do it on their own, like a white hat kind of thing here. So I think that it's a net positive for the ecosystem. And generally, if something has been exploited with a flash loan, then it could have been exploited without a flash loan. It just took the person with the right amount of capital, which will eventually come along anyway. So this kind of stuff where people say, oh, this couldn't have happened if flash loans weren't available. It could. If flash loans just enable the people that aren't rich to be able to do it. But if someone's rich and they want to do it, they'll do it. I mean, look up George Soros and what he did to I think the British pound or something like that, or one of the fiat currencies. He basically shorted that stuff and basically made it lose its peg because he had the money to do so. Now, if there was a flash loan there, any of us could have done that if we wanted to, but he had the money to do it. So I think it just democratizes kind of like access to capital, which I believe is always a pretty a good thing. All right, on to the next update here. So we had the Graph and Optimism teaming up. So the Graph, as everyone knows, is a middleware protocol that it basically serves different queries to different DeFi apps. So whenever you go onto something like Zappa or one of your favorite DeFi front ends, pretty much everything that you see on there is powered by the Graph in terms of like the dollar number you see on the assets and the APY numbers and everything like that is powered by the Graph's querying engine. So this is kind of the infrastructure and the critical infrastructure that's needed for blockchains and for layer 2s as well. Now, obviously, Ethereum has the Graph and like Infura and Alchemy and Etherscan, all this sort of stuff, but Optimism didn't. And this, I think, is the main reason Optimism was delayed in March until July, was because they didn't have any of this infrastructure out there. They didn't have their Etherscan block explorer, which they do now, like Optimism Scan or whatever you want to call it. They didn't have the Graph, obviously they do now. They didn't have Alchemy or Infura, I believe, but I think they do now. And like they obviously had like the wallet infrastructure with MetaMask, but that wasn't enough. You can't bootstrap a new kind of like layer 2 ecosystem without this critical infrastructure in place. And, we've seen Arbitrum doing this over the past couple of months. They haven't launched yet because they're still trying to get this infrastructure in place. And even things like Oracle's count here, like Chainlink, Arbitrum has been supporting Chainlink for a while. Optimism has as well. But that's critical too, because you can't have DeFi without Oracles. Aave couldn't exist on layer 2 without Chainlink, for example. Same with Compound now, and Maker couldn't exist on layer 2 without their own oracles being on there as well. So taking all that together is why I guess like Optimism was delayed back in March. And, in hindsight, it was a pretty obvious delay coming up because they had not like brought out any announcements like this. They had not said that they were getting support from these sorts of teams. So generally, I think that, when you see these layer twos coming online, and if they don't have this infrastructure in place yet, you can be safe to say that they're going to delay their launch, or they're not going to be launched for quite a while because, I don't think any of these solutions want to launch without this infrastructure in place now, because they'll just lose out to their competition, so to speak. So yeah, still cool to see this. The graph is obviously amazing, and I just, at this point, I think over the next 3 months, we're going to see so many L2s go live in a public way. Arbitrum, hopefully Optimism goes live next month. Hopefully they don't delay again. And I think even ZK Sync's mainnet, or maybe even testnet is due for August. So the next 3 months in layer 2 land is going to be pretty fun.
Yeah, mix that with 1559 and eventually the merge. It'll be a fun second half of this year. But yeah, this is great. I mean, we've talked a lot about, at least I've worried about the potential UX of layer 2, and I'm very happy to see teams realizing that it's not even worth really launching until this essential infrastructure is in play, right? We talked a lot about Polygon launching an Etherscan fork, and that makes that network way more enjoyable, right? And I personally feel a lot more comfortable using it. MetaMask makes things easy, but you still want to like see things. And what's funny is, like, when we first started talking about layer 2 years ago, DeFi wasn't what we kind of knew like the vision of DeFi and eventually what it could be, but we didn't have it yet. So a lot of like layer 2 talk, I mean, especially really early on, was just all about like payments, right? Maybe some of the weird Web3 visions that existed back in the day, but really it was just like payments, paying people, payment channels. And that doesn't really require much infrastructure, right? So this was never really a consideration early on. And now you need a lot of things visually in DeFi to like trace transactions and really see what's going on. And the essential parts that are obviously MetaMask, or the wallet of your choice, I suppose. But I think we all know MetaMask is kind of that one at this point. And then you definitely need something like Ether. You need Etherscan, period, not something like it. And then, yeah, you need these other essential tools. Like the graph's definitely one of them. I don't know if people realize how often they're using this, like poking around DeFi. But for example, if you go to like uniswap.info, right, and you're kind of like analyzing a market and seeing the trades and the liquidity, that's querying the graph. So there's a lot of things that you're kind of doing visually that potentially you don't realize that it's using this in the back end. But if you were to go to your favorite layer 2 and you're used to this user experience and all of a sudden uniswap.info is not there, it's going to feel weird. It's not going to feel the same. So it's essential to do this stuff. I'm really glad teams are doing this up front.
Yeah, exactly. For sure. And yeah, I mean, yeah, you mentioned Polygon with like their Polygon scan and things like that. I mean, we've spoken about this before, how we think that like Etherscan has like this amazing moat now where they just build these block explorers for these other networks. And then at the end of the day, like all these kind of, layer 1 and layer 2 networks are going to have the same infrastructure, and it's just going to be up to users and developers to pick where they want to go. I think developers actually have the most power here because they're not going to deploy their apps to like every kind of chain, or if they do, they're going to deploy like older versions to one and newer versions to the other. And I think we've spoken about this before as well, where you kind of like view this ecosystem from a developer mindset, and developers aren't going to maintain their apps on like 20 different chains. That's just not going to happen. It's not easy to do that because anytime they want to upgrade, they're going to have to upgrade it on 20 different things. They're going to have to kind of like, there's kind of like little differences between the networks as well. So I do think it's just going to be a handful, and really it's just going to be a developer and user race to see which one of these things succeed over the long term. All right, on to the last project update. So FutureSwap, haven't heard about this for quite a while. This was big a few months ago, but basically they announced that their V3 is coming soon, and they detailed it in this blog post. It'll be launching natively on Arbitrum's Layer 2, which is very interesting. I'm going to get back to that in a sec, but it also includes a completely redesigned protocol with more leverage and assets to trade as well. So for those who don't know, FutureSwap is basically a derivative exchange, and I think that they've redesigned and are launching natively on Layer 2 because they've seen the success of DYDX. Now, I want to talk about this kind of like thing of launching natively on layer 2 and not launching on layer 1. I think this is the future, because what's the point of launching on layer 1 now when there's layer 2 solutions available? Because in reality, the long term is for everyone to sit at layer 2 anyway. So why would you even try to build a network effect on layer 1 for your app? You wouldn't, because if layer 2 is giving you what you want, if everyone else is at layer 2, because it's looking like there's going to be a lot of people on Arbitrum. Polygon already has like an amazing ecosystem as well. So if everyone else is sitting at these kind of like scaling solutions, then there really is no point launching on layer 1. And this is why I've been saying, I think we've both been saying it for a long time now, that we believe layer 1 is just literally going to be a chain for liquidity pools and whales to sit on, and for layer 2 proofs to be kind of like transacted on. Anything else is just going to be at layer 2, and that's fine. That's exactly how Ethereum has been designed. Ethereum has not been designed as a layer 1 scaling ecosystem. We're not relying on layer 1 scalability to kind of reach the world. So I'm really excited to see more and more projects just launch natively on layer 2 and kind of say, well, we understand the long-term roadmap of Ethereum here. We understand that layer 2 is the future. Let's just focus all our energy there. And this, goes back to what I was just saying about how, developers don't have the capacity to support 20 different networks. They're going to support a handful of them, and I think the less that they have to support, the better, because it means that they can be laser focused on their product instead of having to change things or tweak things or worry about different networks. That's always been my bear case for the multi-chain thesis, is that for developers, it is a nightmare for them to have to maintain code and their apps, and not just the code, but like everything on like a million different networks, and keep it up to date and keep it up to like the latest and greatest. I think that we've seen this play out in the Web 2 world, where developers really hate the fact that they have to support like all these different browsers, and normally you'll just have the main ones supported, like Chrome and Safari and Edge and things like that. But generally, actually a fun fact with the web the web browser kind of ecosystem is that a lot of them speak the same language, because the language is like HTML and CSS, like, and things like that, and like there's different web kits and things like. They all speak very similar languages, and that kind of makes me think of like all these kind of like Ethereum forks, like not Polygon, sorry, but all these EVM compatible things like BSC and things like that, and Phantom, I think, and Hobby Eco Chain or something. They're the same kind of thing here, is where they all use these similar kind of language, because they know that developers don't want to rebuild their stuff from scratch. They want to use what they're used to. That's not to say the future can't be brighter, where developers use different tools and they'll be building things from scratch. I know Starkware has their own smart contract language called Cairo, and they have their own virtual machine. And as I said, DYDX is big on there already, and there's a few other things like Mutable X and stuff like that. But generally, keeping it I guess like uniform for developers is the way to go, because just makes their lives much easier, I believe.
Yeah, this is super interesting, right? Like a native layer 2. I guess in all this talk we've done about this, I never really pictured this, but it makes total sense, right? I mean, and really, so first of all, it's going to be really weird to have like apps that like you couldn't see and use on layer 1. You have to go to layer 2. Like, it just seems like they should start at layer 1 too. But from their perspective, from like future swap and developers, yeah, like why would they start on layer 1, right? If they know most of their users are going to be more interested in the layer 2 solution. And I think where we really kind of like saw these ideas kind of come about is seeing things like BSC, right? And basically like retail, and a lot of retail users and a lot of users on Ethereum that are just priced out of gas fees, they didn't even care about giving up decentralization, right? They wanted to just go trade these shit coins at low fees. Now, the beauty of like Arbitrum, where FutureSwap is going to launch, is you aren't giving up those. It isn't a centralized solution, right? You're not giving up those guarantees that Ethereum can offer you, because everything's settled back to layer 1. So it's kind of the best of both worlds, right? And I think this totally makes sense. This also goes to what you've been preaching a lot, is hopefully exchanges, which are still the the fiat on and off ramp for all of Ethereum, pretty much. I hope they integrate these well, right? Because we still want retail users to come in and get used to DeFi through these layer 2 solutions. It'll be important for them to be able to easily go cash and then straight into these solutions. And there's going to be a few of them. So hopefully that UX is smooth on the exchange side as well. But this is cool. I'm excited to see this. And I'm still just like really anxious to see, I think multiple layer 2s are going to end up winning. There's a lot of strong competitors out there. Over time, maybe a longer time frame, we consolidate to one. I don't know. It's going to be interesting to watch.
Yeah, definitely. I think that whole kind of layer 2 ecosystem is like the next frontier generally, and it's going to be interesting to watch like how that all plays out over the coming year or two. I think we're going to see a lot coming out of that, especially if the market stays quiet, it'll be really cool to focus on like what products are actually getting traction and usage without a hot market. Because as I've said before, I believe that bull markets give teams a false sense of security where they believe that their app is like on top of the world just because people are using it during like a bull market to extract some sort of value out of it. But it's really the bear markets and kind of like the down markets where you see the best apps come out and people use what they actually want to use and not just use it because of they're getting money to use it, basically. All right, last thing here was a few blog posts that Vitalik put out around Verkle trees and state expiry and statelessness. So for those who have never heard of this before, there is a tweet in the ETHUB newsletter from Justin LaRue, a tweet thread where he gives a TLDR on what this is all about. Essentially, Verkle trees allow for some great efficiency gains within Ethereum, and that allows for the statelessness roadmap to be executed on. Now, I'll describe what statelessness is. Basically, Ethereum has a state which keeps track of basically everything on Ethereum, say like account balances and things like that, as an example. So this state is actually the bottleneck, I think, of the Ethereum blockchain in terms of allowing us to scale further, like raising the gas limit on layer 1, and it's a bottleneck for node syncing too. So what if we could actually do a thing where we had a stateless Ethereum, where in order to basically keep track of all this sort of stuff, you would need to provide, I guess, like a proof that you wanted access to this information. So, for example, say that you have like a balance of ETH on your account and you don't touch that account for like 5 years. Well, why does that need to remain in the active state for 5 years if you haven't touched it? So the idea would be that you would have this kind of witness. I think it's called a witness that, 5 years down the line, you would come back and present this witness, and that it would reactivate your account essentially. So basically, I think after a year, your account would go into like a dormant status where your ETH is going to still be there. Your ETH's not going anywhere. But to access it, you would need to provide this witness, and that would reactivate your account on the network, essentially. And this would be done, as I said, in order to kind of like make layer 1 more scalable here and make it like just easier to sync a node and things like that. Now, this isn't anywhere close to being implemented. I think this would come after even sharding, I believe. Maybe it could come before it, but I don't know. It's still a very open kind of research and development thing going on here. And there's still kind of trade-offs as well, because you might be thinking, well, if this is the case, then wouldn't kind of like everyone need to have this witness? And then if you lose your witness, what happens to your account and things like that? Well, I imagine there's going to be third-party services as well out there that keep track of this sort of stuff and keep witnesses for everything, and are able to supply it for you. I think that there's centralization concerns around that, and rightfully so. But this can be built into wallets. Wallets can literally just have like a backup of your witness on your PC. Like MetaMask can just put it on your PC. Ledger, for example, or a hardware wallet can basically put it on their internal storage. So I think generally, for most users, it's going to be fine. But this also applies to developers and to code on the chain and things like that, where they're going to have to supply witnesses for old state as well. If you want to access old state of like a project or something, you would have to supply a witness. So yeah, it's going to be interesting to see how that plays out. It's still very, very early days, but if you want to read more about it, Justin LaRue's tweet thread is in the newsletter here. But yeah, Eric, I mean, this has been on the cards like for ages in Ethereum, right? The stateless roadmap.
Yeah, it seems like almost since the beginning, right? And this becomes interesting in ETH2 as well, of course. And Justin, it's kind of funny. I feel like maybe this was a response subtly to me retweeting Vitalik, because I said I'm going to act like I understand this, and like an hour later, Justin did a great breakdown in thread.
Yeah, I think so.
Yeah, so it might have been a little subtle. tweet at me, but it's a great thread. It helped me a lot kind of visualize it and put it together. So definitely go read it, and you put it together well, so I won't recap it. But yeah, I mean, this is vitally important just to the future of Ethereum, right? Like, we can't allow state size to get too large. We can't allow it to, because if we let it get too large, people can't download it. All of a sudden that becomes centralized. Like, this is the whole problem, right? With like EOS and BSC and stuff like this, that like they aren't thinking about these long-term problems, right? And one thing I love about the Ethereum space is we try things and we say, hey, if that's not perfect, let's move on and try something new, right? And that seems to be what, we're just iterating basically when it comes to this research on the state size side. That's hard to say, state size side. And we saw this with E2, right? Like, at a point, the whole E2 roadmap got kind of squashed and rewritten. And so it's cool to see this research still happening. I mean, still, like, thank God for Vitalik, right? The guy's just a genius. He's a great, I mean, what's funny is he stepped back so much from like a leadership role of Ethereum. Like, early on, people just looked to him for everything. And I think he's done a good job stepping back there. But I mean, he still puts out the most important research, right? I mean, like, it was his paper that led to 1559, right? And the amount of like good quality research that this guy pumps out, that's vital to the future of Ethereum is great. And it's cool to see someone, he rose to fame and fortune fast, right? And he's kept his head on straight, and he's still just down to earth and still working on the protocol. So I just wanted to say big props to him, and thank God he's still around.
Yeah, I mean, for sure. It really always amazes me just how much Vitalik is able to do. I mean, not just within Ethereum, but generally. And I'm not just going to be gushing over Vitalik here, but honestly, like, he is someone that I really do look up to in life, even though he's younger than me, which is a bit odd to say. Like, I look up to someone that's younger than me, but he just handles himself very well. I mean, I listened to his podcast on Lex Friedman's podcast, and it was just amazing. Like, he isn't just into Ethereum. He's across so many different things. Like, as you said, like, there's politics, and then he knows so many different languages as well. I mean, the guy, I don't know how he finds the time to do all of it, but it's just incredible. So yeah, very, very happy that he's still part of the Ethereum ecosystem, and I'm very happy that he had the foresight to just take a step back and let the ecosystem develop on its own instead of trying to control everything. Because at the end of the day, I don't think Vitalik actually wants control of anything, and that can't be said for most other crypto project founders, I believe.
Yeah, I totally agree with that.
Awesome. All right, well, that's it for this week, everyone. So thank you again for listening. You can subscribe to the newsletter at ethub.substack.com. The podcast is at podcast.ethub.io, and we'll catch you all next week. Thanks, everyone.
Thanks for listening to Into the Ether. You can subscribe to the podcast and newsletter at ethub.substack.com, find our website at ethub.io, and follow us on Twitter at @econoar and @sassel0x.